Eli Lilly's $1 trillion market value and weight loss drug dominance have people asking if it's the next FAANG stock, and today we will find out in our 10-minute stock snack. After spending hours analyzing 10 years financial on Eli Lilly, the R&D-focused drug developer, here is the 2 key insights I find out. I'm going to blend the insights in this 10 minutes video for you to snack and go. At Stock Snack, we make stock analysis simple and clearer. Here is the 4-step framework we use to analyze every stock. First, the price projection. We identify the stock's profit potential over the next 10 years. Second, the benchmark test. We compare that potential profit against the market giants, the S&P 500. Which is better? Third, the business model. We analyze the company's story and its revenue source to see if the profit is sustainable. Fourth, the financial health check. We run the numbers to expose the underlying risk and strength. By the end of this video, you will know what is the profit. Is the profit good or bad? What is this company doing? And if it is financially healthy. Okay, let's start with the price projection. We are using 3 approaches from their profit, from their cash flow, and their dividend. Right now, the price of Eli Lilly is $1.1K. First, estimate Eli Lilly stock price 10 years later with their profit. With the growth of Eli Lilly, we think the price will be $2.8K 10 years later. I then do the similar analysis with cash flow and dividend. The detailed calculation, find it in my channel. And we average all 3 analysis up, Eli Lilly will worth $2K, which is 0.8 times return in 10 years' time, or estimate CAGR of 6.3%. The profit is around double the money you put in. To know if it is good enough, we will compare it with a market S&P 500. S&P 500, the 500 largest U.S. company. It is currently priced at $617, and we estimate that it will be $2,200 10 years later. This estimation is based on the last 10 years' growth, which also means the estimated profit on investing in S&P 500 is 2.5 times with CAGR of 13.35%. So, to conclude the price projection, Eli Lilly, the R&D-focused drug developer, is bringing us profit of 0.8 times, with CAGR of 6.3%. And the S&P 500 is bringing us profit of 2.5 times, with CAGR of 13.35%. Therefore, we can conclude that the S&P 500 is a better investment than the Eli Lilly, the R&D-focused drug developer. Analyze stocks can be challenging. Therefore, I am leveraging on this site. Access historical data of annual reports in just 1 click. If you're into fundamental analysis, trust me, you will love it. You can find the link in description below. Next part of our framework, understand the business. 2 parts, the general information and the revenue source analysis. Starting from the general information. In short, this company began with Colonel Eli Lilly in Indianapolis, aiming to solve medical problems. Major breakthroughs include the first commercial insulin, mass-produced penicillin, Humulin, and Prozac. Today, the focus is on R&D, specifically for diabetes and cancer, riding the GLP-1 wave. Led by Dave Ricks, the future involves increased GLP-1 production, new drug pipelines, and using AI for discovery. Risks include manufacturing challenges and fierce competition. The company continues its founding DNA, solving big health problems with big science. Next up, the revenue source analysis. Diabetes is the engine, driving over half the business and growing strong at 20%, well above the benchmark. Watch Immunology closely. It's a smaller slice but has wild growth, near 40% CAGR, showing future star potential to reshape the business mix. Oncology is a solid, reliable second pillar, growing above the benchmark. The stability of diabetes and the breakout pace of immunology are the real stories behind the numbers. Right, last steps of the framework. The financial health. For Eli Lilly, financial statements. The combined financial score is bad, with only 9 metrics scoring well out of 22 total metrics. Breaking down the details, the balance sheet is bad. Out of the 7 metrics we checked, only 3 receive a good score. Moving to the income statement, that section is good. We checked 9 metrics here, and 5 of those metrics scored well. Lastly, the cash flow is bad. Checking 6 metrics, we found only 1 metric with a good score. In conclusion, when we look at Eli Lilly, we see a highly efficient, high-leverage company that's achieving massive growth and delivering excellent returns. However, it's important to note they maintain a weak balance sheet. This is primarily due to high debt levels and massive, aggressive spending, particularly on capital expenditures and significant shareholder payouts. To go through the detailed financial statement analysis, check out the other video in my channel. The conclusion: buying Eli Lilly, the R&D-focused drug developer stock. By the profit-wise, S&P 500 is having more potential than Eli Lilly. At the same time, it does not have good financial health too, potentially not worth your time. Now, the analysis is complete. Once again, if you needed tools for your investment strategy, give a try on the site I use. Link is in the description below. They provided sufficient free tools for you to work around. If you ever want an upgrade, promo code is StockSnack. Institutional grade data with less than $1 a day. One day, one stock. See you again at StockSnack.